Listen to me very carefully because what I am about to tell you could save your family hundreds of thousands of dollars. Or cost them a fortune if you get it wrong. I'm Raoul Pal, and I've spent my entire career studying how money moves, how wealth is built, and more importantly, how wealth is kept across generations, because building wealth is hard, but losing wealth, that can happen with one careless decision. One document you sign without understanding the consequences. And today I am going to show you the single biggest tax mistake people make when they try to pass their home to their kids. It's one of the most common mistakes in America, and it's so painful because people make it with the best intentions. They're trying to help their kids. Avoid hassle. Avoid legal headaches. Avoid probate. And they accidentally create a tax bill so massive it can wipe out a huge chunk of the inheritance. So let's go through this slowly, clearly, and properly, because if you own a home and you have children, this matters. Now, before we get into it, I want you to do one thing for me. Subscribe, because this channel isn't about hype, it's about reality. It's about protecting your wealth. It's about making sure the system doesn't quietly take what you spent your entire life building. Now, here's the situation. Right now, millions of parents in America are sitting on homes that have appreciated massively over the last 20, 30, 40 years. You bought your home for $120,000 in the 90s. Today it's worth $700,000 or $1 million or more, and you look at that and you think, wow, this is the biggest asset I own. And for most people, it is. For most families, the home is 50%. Sometimes 70% of total net worth, which means if you mess up the transfer of the home, you're not making a small mistake, you're making a generational mistake. You're taking the single biggest thing your family owns and handing a huge portion of it to the tax system for no reason. And the reason it happens is because people believe something that sounds smart. They think, I'll just add my kids to the deed while I'm still alive. They think it's clean, easy, no probate, no lawyers, no delays, just add the kid's name. And when I'm gone, the house automatically becomes theirs. That's what people are told. And that is the tax disaster. That is the mistake. That is the trap. So let me say it clearly. Adding your child to your deed while you're alive is one of the most expensive financial mistakes you can make, and I'm going to show you exactly why. Because this is not just a small paperwork issue. This is about something called cost basis, and cost basis is the invisible number that decides whether your child inherits your home with zero tax, or with a tax bill that feels like a robbery. Here's how it works. Let's say you bought your house in 1995 for $150,000. Over the years, you upgraded it. New kitchen, new roof, bathroom renovation, landscaping. Maybe you put $50,000 into improvements. So now your total cost basis is $200,000. But today the home is worth $900. 000. Okay? So you've got a $900,000 asset. That originally cost you $200,000. Now here's where the mistake destroys families. If you add your child's name to the deed while you're alive, you are making a gift. And when you gift property, your child inherits your original cost basis, not the current market value, your basis, your 1995 basis, your $200,000 basis, which means the tax system sees it like this. Your child received a home worth $900,000, but the cost is still $200,000, so if your child later sells the house for $900,000, they don't pay tax on the full $900,000, they pay tax on the gain, $900,000 minus $200,000. That's a $700,000 capital gain, and now your kid is holding a tax bomb. That $700,000 gain gets taxed, federal capital gains, possibly 15% or 20%, maybe the net investment income tax, and then state taxes depending on where you live. And if you're in a high-tax state, this can get brutal. This can easily be 1,000,000,220,000 in taxes. Just because you tried to make it easy, let that sink in. You did all the work, you bought the house, you paid the mortgage, you built the wealth, and one signature. One simple idea turns your family's inheritance into a huge IRS donation. Now, the reason people do this is because they're scared of probate. Probate sounds like this dark, scary legal monster. And yes, probate can be annoying. Sometimes it's slow. Sometimes it costs a few $1,000s, sometimes it's paperwork, but you need to understand something. Probate is usually far cheaper than destroying the step-up in basis. Most probates might cost $3,000 to $5,000 in many situations. Meanwhile, this deed mistake can cost your kids $150,000 or more. So what are we doing here? You're trying to avoid a small inconvenience, and you accidentally create a massive financial disaster. That's like avoiding a parking ticket by setting your car on fire. It makes no sense, and it gets worse, because adding your child to the deed doesn't just create tax problems, It creates risk problems, legal problems, family problems. Because the moment your child is on the deed, your home is now part of their legal world. That means if your child gets sued, car accident, business issue, lawsuit, your house is exposed if your child gets divorced. Your home is now potentially part of a divorce settlement. Half of your family home could end up legally connected to someone you never intended to benefit if your child has debt, or bankruptcy, or creditors. That home becomes a target, and here's the part nobody thinks about. Once your child is on the deed, you lose control. You can't just take them off. You need their permission. So if you change your mind, if relationships change, if you need to sell for medical expenses, if you need to move, you now need cooperation. You've turned your own home into a shared asset, and at 70 or 80 years old, you do not want to be negotiating your biggest financial asset with other people's lives, other people's spouses, other people's stress. I've seen this turn into family wars, sibling wars, court battles, years of resentment. All because somebody thought they were being smart. Now, here's the solution, and this is the part that saves families a fortune. It's called the step-up in basis. And this is the magic weapon most people don't know they already have. When you die and your home passes to your children properly, your children receive the home with a new cost basis, not your old cost basis. The basis becomes the fair market value at the time of your death. So in that same example, you bought for $200,000 basis. But the home is worth $900,000 when you pass. Your child inherits it at a $900,000 basis. So if they sell it shortly after for $900,000, guess what the taxable gain is? Zero. No gain, no tax, even if they sell it later for $950,000. They pay tax only on the $50,000 increase after you passed, not the entire 30-year appreciation. That's the difference between losing $150,000 and losing almost nothing. This one concept changes everything, and it's why the tax mistake is so devastating. Because adding your kid to the deed destroys the step up, but letting your kid inherit it properly preserves the step up. So the rule is simple: die owning the house, your kids get the step up, gift the house while alive, your kids inherit your old basis and get taxed heavily. Now I can hear the next objection already. Okay, Raoul, but I still want to avoid probate. Good news, you can avoid probate and keep the step up. You don't have to choose. That's where a revocable living trust comes in. This is the cleanest structure for most families. Here's how it works. Simply, you set up a trust. You stay in control. You remain the trustee while you're alive. You move the home into the trust. You name your kids as beneficiaries. During your life, nothing changes. You still live there. You can sell it, refinance it, do whatever you want. You control the asset. But when you pass, the home passes to your kids without probate. And because it's still considered part of your estate, your kids still get the step up in basis. That's the best of both worlds. Fast transfer, private transfer, no probate delays, no court supervision, and minimal capital gains tax risk. Now, people hear trust and they think it's expensive or complicated. It's not. For most families, you can set one up for a few $1,000s, sometimes less, and the value is insane. You spend $2,000 to potentially save your children $150,000. That's not a cost. That's one of the best financial decisions you'll ever make. Now let me address another common mistake. Some parents try to be clever. They put only one child on the deed, usually the responsible one. They say, this child will handle it fairly and distribute it later. That is how families get destroyed, because now you're creating a power imbalance, and you're relying on trust after grief, after emotions, after pressure from spouses, after new life situations, and you're still causing tax damage on part of the basis. It's messy, it's risky, it's unnecessary. The clean structure is this: don't add anyone to the deed while you're alive. Use a trust, keep control, preserve the step up. Now let's talk about the estate tax, because some of you are worried about that. Most people do not need to worry. For the vast majority of families, federal estate taxes are not the issue. The issue is capital gains taxes and transfer mistakes. So don't let fear of estate taxes cause you to do the wrong thing. If you are one of the rare cases with a very large estate, you need an expert attorney anyway, but for most people, revocable trust and step up, that's the play. Now, timing matters. If you've already made the mistake, if you already added your kid to the deed, you may still be able to fix it. In many cases, your child can sign a quitclaim deed to transfer it back. Then you set up the trust properly, but you need to do this with professional guidance, because the longer you wait, the more likely something happens and it becomes irreversible. This is one of those things people procrastinate on until it's too late, and the moment you pass, Your family is stuck with the consequences. So here are your action steps. Simple, clear, do this. Step 1. Do not add your kids to the deed while you're alive. If you already did, fix it with an attorney immediately. Step 2. Find a qualified estate planning attorney in your state, not your friend's cousin, not generic legal help, a specialist. Step 3. Set up a revocable living trust. Step 4. Fund the trust properly. That means your home must actually be deeded into the trust. Step 5. Review it every few years. Major. Life changes, new kids, new state, new laws update. That's it. And if you do that, you dramatically reduce risk. You protect your kids. You protect the home you spent your life paying for. And you avoid one of the biggest wealth transfer tax traps in the entire system. Because remember, wealth isn't just built by investing well. Wealth is kept by not making catastrophic mistakes. And this deed mistake is catastrophic. So here's my challenge to you: if you own a home and you have kids, make this a priority, not next year, not when you get around to it. Do it now, because the cost of doing it is small. And the cost of avoiding it can be enormous. Subscribe if you want more of these practical wealth protection breakdowns. Like the video so more people see it and save their families a fortune. And comment below, do you already have a trust? Or are you going to set one up after watching this? This is Raoul Pal. Stay smart, stay protected, and I'll see you in the next one.